15 questions 50% CFA Level 1 candidates failed to grasp, including 4 crucial ones at the end. Impairment and derecognition of assets. Question 15. An analyst is reviewing the impairment of a manufacturing plant for KLP GmbH, a German company that reports under IFRS. She collects the following data. Fair value 12,500,000 euros. Cost to sell 500,000 euros. Value in use 11,800,000 euros. Net carrying amount euros 13,200,000. Based on this information, the impairment loss that KLP must report on its income statement is closest to A 700,000 euros, B 900,000 euros, C 1,200,000 euros. Correct answer, C. Under IFRS, recoverable amount of an asset is the higher of its fair value less cost to sell and its value in use. Fair value less cost to sell equals 12,500,000 euros minus 500,000 euros equals 12 million euros. Value in use equals 11,800,000 euros. Recoverable amount equals max 12 million euros. 11,800,000 euros equals 12 million euros. Compare the recoverable amount to the net carrying amount. Net carrying amount equals euros 13,200,000. Recoverable amount equals 12 million euros. Since the net carrying amount, euros 13,200,000, is greater than the recoverable amount, 12 million euros, the asset is impaired. Impairment loss equals net carrying amount minus recoverable amount. Impairment loss equals euros 13,200,000 minus 12 million euros equals 1,200,000 euros. Therefore, the impairment loss that KLP GmbH must report on its income statement is closest to 1,200,000 euros. Question 14. An analyst is reviewing the impairment of a manufacturing plant for KLP GmbH, a German company that reports under IFRS. She collects the following data. Fair value 12,500,000 euros. Cost to sell 500,000 euros. Value in use 11,800,000 euros. Net carrying amount euros 13,200,000 according to IFRS. How is an impairment loss for a piece of manufacturing equipment measured? A as the excess of the carrying amount over the asset's undiscounted future cash flows. B as the excess of the carrying amount over the asset's recoverable amount. C as the excess of the asset's historical cost over its fair value less cost to sell. Correct answer, B. IFRS Standard, IAS 36, clearly states that an impairment loss occurs when the carrying amount of an asset exceeds its recoverable amount. Recoverable amount is defined as the higher of the fair value less cost to sell and the value in use. This ensures that the asset is valued at the most realistic amount it can generate either through sale or continued use. For KLP GmbH, the fair value less cost to sell is 12 million euros, and the value in use is 11,800,000 euros. The recoverable amount is the higher of these two, which is 12 million euros. The net carrying amount is 13,200,000 euros, so the impairment loss is the excess, which is 1,200,000 euros. A. Incorrect. This method is used under US GAAP, not IFRS. US GAAP first uses undiscounted future cash flows to determine if an asset is impaired. If the carrying amount exceeds these undiscounted cash flows, further testing is done to measure the impairment loss. IFRS does not use undiscounted cash flows for impairment measurement. Instead, it uses the recoverable amount, which involves discounted future cash flows, value in use, or fair value less cost to sell. C. Incorrect. Impairment loss under IFRS is not based on the historical cost of the asset. Historical cost is the initial purchase price, but the carrying amount reflects the current book value after depreciation and previous impairments. IFRS focuses on the recoverable amount, which is the higher of fair value less cost to sell and value in use. This approach provides a more realistic and current valuation of the asset's ability to generate future economic benefits. Using historical cost would not accurately reflect the asset's current value or its potential to generate future cash flows. For KLP GmbH, the focus is on the carrying amount, 13,200,000 euros, and the recoverable amount, 12 million euros, not the historical cost. Question 13. An analyst is reviewing the impairment of a manufacturing plant for KLP GmbH, a German company that reports under IFRS. She collects the following data. Fair value 12,500,000 euros. Cost to sell 500,000 euros. Value in use 11,800,000 euros. Net carrying amount. Euros 13,200,000. The recognition of an impairment loss on a finite-lived intangible asset, such as a patent, most directly affects only the statement of cash flows. B. Both the income statement and the balance sheet. C. Only the shareholders' equity section of the balance sheet. Correct answer, B. On income statement. The impairment loss is recognized as an expense, reducing net income for the period. This is the direct and immediate recognition of the decline in value. On balance sheet, the carrying amount of the intangible asset is reduced by the amount of the impairment loss, which lowers total assets. The resulting lower net income then flows into retained earnings, further reducing equity indirectly. Impairment affects both performance through the income statement and financial position through the balance sheet. A. Incorrect. Impairment losses are non-cash charges. They appear on the statement of cash flows only as adjustments under the indirect method to reconcile net income to cash from operations. There is no direct cash movement when impairment is recognized. Impairment is purely accounting-based, not a cash transaction. C. Incorrect. Shareholders' equity is affected indirectly through lower retained earnings after net income declines. The impairment loss is not recorded directly in equity. It is recognized first as an expense in the income statement. The asset's carrying amount is also reduced, so the impact is not limited to equity. IFRS requires impairment recognition in profit or loss, not as a direct equity adjustment. The key understanding is that impairment losses reduce both the value of the asset, balance sheet effect, and profit for the period, income statement effect. But they do not involve any immediate cash flow or direct equity entry. Question 12. A logistics company revises the estimated useful life of its fleet of trucks from 10 years to 8 years. The trucks have a net carrying amount of $16 million at the beginning of the year. The company uses the straight-line method with no salvage value. Ignoring taxes, the most likely immediate effect of this change is a higher fixed asset turnover ratio, B. A lower cash flow from operations, C. An unchanged net profit margin. Correct answer, A. Fixed asset turnover ratio equals revenue divided by average net fixed assets. When the company revises the estimated useful life of its trucks from 10 years to 8 years, the annual depreciation expense increases. Using the straight-line method with no salvage value, the original annual depreciation was $16 million divided by 10 years, which equals $1.6 million per year. After the change, it becomes $16 million divided by 8 years, which equals $2 million per year. Higher depreciation reduces the book value of the fixed assets more quickly. Revenue is not directly affected by the change in depreciation calculation. Since the numerator, revenue, remains the same, and the denominator, net fixed assets, starts to decline at a faster rate due to higher depreciation, the fixed asset turnover ratio increases immediately. B. Incorrect. Cash flow from operations is calculated starting with net income, and then adding back non-cash expenses, like depreciation, and adjusting for changes in working capital. The increase in annual depreciation from $1.6 million to $2 million will reduce net income because depreciation is an expense on the income statement. However, when calculating cash flow from operations, depreciation is added back to net income. The reduction in net income due to higher depreciation is exactly offset by the addition of the higher depreciation amount when calculating cash flow from operations. So, ignoring taxes, the change in the estimated useful life of the trucks does not directly affect cash flow from operations. There is no immediate decrease in cash flow from operations as a result of this change. C. Incorrect. The net profit margin is calculated as net income divided by revenue. As mentioned earlier, the increase in annual depreciation from $1.6 million to $2 million will reduce net income. Since revenue remains the same, as it is not affected by the change in the estimated useful life of the trucks, the ratio of net income to revenue, net profit margin, will decrease, not remain unchanged. A higher depreciation expense resulting from the revised shorter useful life will reduce net income. Unless revenue changes by a perfectly offsetting amount, the net profit margin will decrease. Question 11. In the current year, a consumer goods company recognized a substantial impairment loss on a trademark acquired in a previous business combination. Which of the following is the most accurate statement regarding the effect of this impairment? A. It indicates that amortization expense in prior years was likely excessive. B. It will result in a higher return on assets in the year of the impairment. C. It reduces the asset's carrying amount, which will lower future amortization expense. Correct answer, C. An impairment loss is recognized when the carrying amount of an asset exceeds its recoverable amount. Recognizing an impairment loss reduces the carrying amount of the asset to its recoverable amount. For finite-lived intangible assets, such as some trademarks, amortization is calculated based on the carrying amount of the asset. A reduction in the carrying amount of the asset will result in a lower future amortization expense, because the new lower carrying amount is the basis for calculating future amortization. This option accurately reflects the accounting treatment and impact of recognizing an impairment loss on an asset. A. Incorrect. An impairment loss does not indicate that amortization expense in prior years was excessive. Amortization is based on the initial estimated useful life and residual value of the asset, and it is calculated systematically over the asset's useful life. Impairment is a subsequent event that reflects a decline in the asset's value due to factors such as changes in market conditions, technological advancements, or legal restrictions. Therefore, recognizing an impairment loss does not imply that prior amortization was excessive or incorrect. B. Incorrect. Return on assets is calculated as net income divided by average total assets. Recognizing an impairment loss reduces both net income, due to the expense, and total assets, due to the reduction in the asset's carrying amount. However, the reduction in net income is typically larger than the reduction in total assets, leading to a lower ROA in the year of the impairment. Therefore, recognizing an impairment loss does not result in a higher ROA. Instead, it usually results in a lower ROA due to the significant impact on net income. Question 10. An analyst is assessing the impairment of a specialized factory for Vostok Machinery, a Russian company reporting under IFRS. The analyst gathers the following information. Fair value 8,400,000 Russian rubles. Cost to sell 400,000 Russian rubles. Value in use 7,600,000 Russian rubles. Net carrying amount 9,800,000 Russian rubles. Based on this information, the impairment loss that Vostok Machinery must report is closest to 1,200,000 Russian rubles. B. 1,400,000 Russian rubles. C. 1,800,000 Russian rubles. Correct answer, C. 1,800,000 Russian rubles. Recoverable amount is the higher of the asset's fair value less cost to sell and its value in use. Fair value 8,400,000 Russian rubles. Cost to sell 400,000 Russian rubles. Fair value less cost to sell equals fair value minus cost to sell. Fair value less cost to sell equals 8,400,000 Russian rubles minus 400,000 Russian rubles equals 8 million Russian rubles. Value in use 7,600,000 Russian rubles. Fair value less cost to sell 8 million Russian rubles. Recoverable amount equals higher of value in use. Fair value less cost to sell. Recoverable amount equals higher of 7,600,000 Russian rubles. 8 million Russian rubles equals 8 million Russian rubles. Net carrying amount 9,800,000 Russian rubles. Recoverable amount 8 million Russian rubles. Impairment loss equals net carrying amount minus recoverable amount. Impairment loss equals 9,800,000 Russian rubles minus 8 million Russian rubles equals 1,800,000 Russian rubles. Question 9. An analyst states the following about depreciation methods. If a company's revenue is stable, the choice of depreciation method will create a distinct trend in its net profit margin. The double declining balance method will create a declining trend, while the straight line method will create a stable trend. Is the analyst's statement correct? The statement is correct. B. The statement is incorrect. The double declining balance method creates an improving trend. C. The statement is incorrect. The straight line method creates a declining trend. Correct answer, B. The double declining balance method is an accelerated depreciation method. It results in higher depreciation expenses in the early years and lower expenses in the later years. When revenue is stable, higher depreciation expenses in the early years lead to lower net income and net profit margin. Conversely, lower depreciation expenses in the later years lead to higher net income and net profit margin. Therefore, the double declining balance method creates an improving trend in net profit margin over time. The analyst's statement that the double declining balance method creates a declining trend is incorrect. A. Incorrect. This option confirms the analyst's statement as correct. However, the analyst's statement is incorrect regarding the trend created by the double declining balance method. As explained above, the double declining balance method creates an improving trend, not a declining trend. C. Incorrect. This option states that the straight line method creates a declining trend in net profit margin. This is incorrect because the straight line method charges equal depreciation expenses over the useful life of an asset. When revenue is stable, equal depreciation expenses result in a relatively stable net income over time. Consequently, the net profit margin also remains stable. The analyst's statement that the straight line method creates a stable trend is correct, but this option incorrectly suggests a declining trend. The double declining balance method creates an improving trend in net profit margin over time. The straight line method creates a stable trend in net profit margin over time. The analyst's statement is incorrect because it misrepresents the trend created by the double declining balance method. Question 8. A company records an impairment loss on a finite-lived patent. Which of the following best describes the financial impact of this impairment? A. It will increase the company's fixed asset turnover and decrease its cash flow from investing. B. It will decrease the company's total assets and have no direct impact on its cash flow from operations. C. It will decrease the company's net income and increase its interest coverage ratio. Correct answer, B. A patent is an intangible asset. When impaired, its carrying value on the balance sheet is reduced. Since total assets include all assets, intangible and tangible, reducing the patent's value directly lowers total assets. Impairment is a non-cash expense, meaning no actual cash is paid out. Under the indirect method of calculating CFO, net income, reduced by the impairment loss, is adjusted by adding back non-cash expenses, like impairment. This means the impairment itself does not change the cash generated from operations. A. Incorrect. Fixed asset turnover equals revenue divided by average fixed assets. Patents are intangible assets, not fixed assets, which typically refer to property, plant, and equipment. Even if broadly interpreted to include intangibles, the impairment reduces the asset base, denominator, which could mathematically increase the ratio. However, this is not the primary focus of the question. Cash flow from investing involves actual cash transactions related to buying or selling long-term assets, such as purchasing equipment, or selling a subsidiary. Impairment is a bookkeeping entry and does not involve any cash outflow, so it has no effect on cash flow from investing. C. Incorrect. Impairment is an expense recognized on the income statement, which reduces net income. This part is correct. Interest coverage ratio equals earnings before interest and taxes, EBIT, divided by interest expense. Impairment reduces EBIT since it is an operating expense that lowers pre-tax income. With a lower EBIT, numerator, and unchanged interest expense, denominator, the ratio decreases, not increases. Impairment reduces the carrying value of an asset, such as a patent lowering total assets. Impairment is a non-cash expense, so it does not directly affect cash flow from operations, though it reduces net income, which is adjusted for in the cash flow statement. Impairment does not involve cash transactions, so it does not affect cash flow from investing. Impairment reduces EBIT, which lowers the interest coverage ratio, a measure of a company's ability to pay interest on its debt. Question 7. A company sells a piece of machinery on December 31st for $75,000. The machinery was purchased on January 1st 3 years ago for $120,000. The company estimated a useful life of 8 years and a residual value of $16,000 using the straight-line depreciation method. The gain or loss on the sale is closest to A loss of $6,000, B gain of $9,000, C gain of $21,000. Correct answer, A. Annual depreciation equals $120,000 cost minus $16,000 residual value divided by 8 years useful life equals $13,000 per year. Accumulated depreciation over 3 years equals $13,000 per year times 3 years equals $39,000. Book value at sale equals $120,000. Cost minus $39,000 accumulated depreciation equals $81,000. Gain or loss on sale equals $75,000. Sale price minus $81,000. Book value equals negative $6,000. The negative result minus $6,000 indicates a loss. This is because the machinery was sold for less than its book value at the time of sale. Straight-line depreciation is calculated evenly over the useful life of the asset. Annual depreciation equals cost minus residual value divided by useful life. Accumulated depreciation is the total amount of depreciation expense that has been recorded for the asset over its useful life up to the point of sale. Book value is the value of the asset on the balance sheet, calculated as cost minus accumulated depreciation. Gain or loss on sale is determined by comparing the sale price to the book value. If the sale price is higher than the book value, a gain is realized. If the sale price is lower than the book value, a loss is realized. Question 6. A company sold a factory for $20 million, which resulted in a loss of $4 million. The factory had a historical cost of $35 million. The accumulated depreciation on the factory at the time of sale was closest to $11 million, B $15 million, C $19 million. Correct answer, A. The loss on sale is $4 million. This means the factory's book value, carrying amount, was higher than the sale price. Loss equals sale price minus book value. Book value equals sale price plus loss equals $20 million plus $4 million equals $24 million. Book value equals historical cost minus accumulated depreciation. Accumulated depreciation equals historical cost minus book value. Accumulated depreciation equals $35 million minus $24 million equals $11 million. The loss on sale indicates that the book value of the asset was higher than the sale price. The correct accumulated depreciation must align with the given loss on sale. Question 5. A company that uses the revaluation model for its buildings under IFRS sells a property. The building was last revalued to a carrying amount of 50 million euros. The company sells the building for 62 million euros. The gain on the sale is calculated as the sale proceeds, minus which of the following amounts? The building's original historical cost. B. The building's carrying amount at the time of sale, 50 million euros. C. The building's carrying amount adjusted for any previous impairment losses. Correct answer, B. Under IFRS IAS 16, the gain or loss on disposal of property, plant, and equipment is calculated as the difference between the sale proceeds and the carrying amount at the time of sale. The carrying amount reflects the asset's value on the balance sheet after all adjustments, revaluations, depreciation, impairments. In this case, the calculation is 62 million euros sale proceeds minus 50 million euros carrying amount equals a gain of 12 million euros. This approach is consistent regardless of whether the cost model or revaluation model is used. The fundamental principle for calculating gains or losses on disposal is to compare sale proceeds with the carrying amount at the time of sale. The carrying amount reflects the asset's current book value after all relevant adjustments, revaluations, depreciation, impairments. Historical cost is only relevant under the cost model and becomes irrelevant once an asset is revalued. The revaluation model requires using the most recent carrying amount for disposal calculations, not adjusted historical figures. Any revaluation surplus in equity related to the disposed asset is transferred to retained earnings separately and does not affect the income statement gain calculation. Four crucial questions. Question 4. An analyst gathers the following information in euros millions about a manufacturing facility. Carrying amount prior to impairment 80. Present value of expected future cash flows, value in use 65. Fair value if sold 58. Cost to sell 3. The carrying amount of the facility after impairment under IFRS is closest to A. 55, B. 58, C. 65. Correct answer, C. Under IFRS IAS 36, an asset is impaired when its carrying amount exceeds its recoverable amount. Recoverable amount is defined as the higher of value in use, present value of expected future cash flows. Fair value less cost to sell, net selling price. Fair value less cost to sell 58 million minus 3 million equals 55 million. Compare with value in use 65 million. Recoverable amount is the higher of these two 65 million. Compare carrying amount 80 million with recoverable amount 65 million. Since 80 million is greater than 65 million, impairment exists. Write down asset to recoverable amount 65 million. IFRS always uses the higher of value in use or fair value less cost to sell. The impairment write-down brings the asset to its recoverable amount, not below it. Must follow the specific IFRS rules rather than US GAAP or other frameworks. Under IFRS, compare the carrying amount with the recoverable amount, higher of value in use or fair value less cost to sell, and write the asset down to that recoverable amount if impaired. Question 3. A company sells a building for cash at a price that is $2 million greater than its net book value. Ignoring taxes, the immediate effect of this transaction is A. A gain reported within cash flow from operations. B. Higher fixed asset turnover ratio. C. Lower return on assets, ROA. Correct answer, B. Fixed asset turnover ratio equals net sales divided by average fixed assets. Fixed assets, denominator decrease because the building is removed from the balance sheet. Net sales, numerator remain unchanged. The sale is not part of call revenue. A lower denominator with an unchanged numerator results in a higher ratio. Fixed asset turnover ratio is directly affected by changes in fixed assets and sales. A. Incorrect. The gain is reported on the income statement, not directly in the cash flow statement. Cash proceeds from the sale are classified as cash flow from investing activities, not operations. Under the indirect method, the gain is subtracted from net income in the operating section to avoid double counting, since the full proceeds are in investing activities. Gains on asset sales are removed from operating cash flow, not reported within it. Cash flow classification distinguishes between operating and investing activities. See incorrect. ROA equals net income divided by average total assets. Net income, numerator increases by the amount of the gain, $2 million. Decrease by the building's net book value. Increase by the cash received, but net effect is usually an increase equal to the gain. Both numerator and denominator typically increase, making ROA more likely to rise, not fall. ROA would increase, not decrease, making this option incorrect. ROA analysis requires considering both net income and total asset changes. Question 2. A company retires an old piece of machinery that is fully depreciated and has a carrying amount of 0. The accounting entry to record this retirement will most likely involve A. Recognizing a gain on the income statement. B. Reducing the asset in accumulated depreciation accounts by equal amounts. C. Recognizing a loss equal to the asset's original historical cost. Correct answer, B. When a fully depreciated asset is retired, its carrying amount is 0. Historical cost minus accumulated depreciation equals 0. The accounting entry must remove both the asset's original historical cost and its corresponding accumulated depreciation from the balance sheet. The journal entry involves debiting accumulated depreciation to eliminate its credit balance and crediting the asset account to eliminate its debit balance. Since the carrying amount is 0 and no cash proceeds are received, no gain or loss is recognized on the income statement. This ensures the accounting equation, assets equals liabilities plus equity, remains balanced while cleaning up the balance sheet. A. Incorrect. A gain is only recognized when proceeds from disposal exceed the asset's carrying amount. In this scenario, the asset is retired with no cash proceeds and its carrying amount is 0. Since there is no compensation received and no remaining value on the books, there is no basis for recognizing a gain. Recognizing a gain would incorrectly imply the company received value greater than the asset's book value, which is not the case here. C. Incorrect. A loss is recognized when proceeds from disposal are less than the asset's carrying amount. The fully depreciated asset has a carrying amount of 0, meaning its original historical cost has already been fully offset by accumulated depreciation. Since the carrying amount is 0, there is no remaining value to write off, and thus no loss can be recorded. Recognizing a loss equal to the original historical cost would incorrectly assume the asset still had value on the books, which contradicts the fact that it is fully depreciated. Question 1. An analyst gathers the following information about a company's vehicle. Historical cost $50,000. Accumulated depreciation at the time of sale, $35,000. Sale proceeds $12,000. The result of the sale is A gain of $3,000. B loss of $3,000. C loss of $38,000. Correct answer, B. To determine this, first calculate the carrying amount or book value of the vehicle by subtracting the accumulated depreciation from the historical cost. $50,000 minus $35,000 equals $15,000. Then compare the sale proceeds to the carrying amount. Since the sale proceeds, $12,000 are less than the carrying amount, $15,000, there is a loss. The amount of the loss is the difference between the carrying amount and the sale proceeds. $15,000 minus $12,000 equals $3,000. The incorrect answers demonstrate common mistakes, such as ignoring accumulated depreciation or misinterpreting the relationship between sale proceeds and carrying amount.